So I think the alternative for the high frequency trader is just to recognize that you have a lot more trades going on and you're going to get 1099 DAs that probably have some big numbers and you need to account for those on your tax return. With regards to the 1099 DAs, you have a choice. You can choose to do all your trading on one platform so that the one platform can report both your cost basis and your sales price and your total gain all on one 1099 form. And in effect, this is what's happening on stock brokerages like Merrill Lynch and Fidelity. You buy, sell, do everything on one exchange, and that one 1099 tells the whole story, and it's very easy to put on your tax return. Now, a lot of people wouldn't like that strategy because, well, they don't want to keep all their assets on one exchange, not your keys, not your coins. The ultimate strategy is to offload everything to private wallets and decentralized. If you keep everything off the centralized exchanges, the only time you're going to use the centralized exchanges is pretty much when you're going out of cash, and those activities are going to be reported on a 1099. I tend to think for the crypto trader, the first option, which is to keep everything on an exchange, is just not an acceptable risk given how many exchanges have collapsed and the lack of the federal government really stepping up through the Clarity Act to really embrace crypto exchanges. But you also need to at least have prepared an accounting of what's happening on decentralized exchanges. Because the way an audit would work is they would trigger something based on what they see with the 1099 DAs and your tax return. And then they open up an audit. And then once they open up an audit, they ask for your transaction history, the exchanges you work on. They start to poke around. And pretty soon they realize you have pretty significant decentralized activity going. And that's going to demand a whole lot more information and basically a can of worms for you. So my best recommendation if you're a high frequency trader is this. You should have professionals do your gain calculation. You can't do this with accuracy with a do-it-yourself system. And you should report all your crypto activity on your tax return, accounting for your 1099 DAs. And you should follow our bulletproof tax return methodology to add additional things to your tax return to discourage IRS from auditing you in the first place. That is our best strategy. And the proof point is that we've done over 5,000 crypto tax returns. None of them have been audited on their cryptocurrency reporting. We believe that it's because we do a great job and our clients can sleep at night knowing that they're completely safe and that they have no fears. So that's my advice. We have a whole system of doing that, including a tax shield monitoring service. You should speak to one of my directors and learn about how we could be a part of your tax strategy for the future.